Joining us right now is Ann Bartels, who is the chief investment strategist at Sanctuary Wealth. And I think, Ann, the biggest question has to be this big run-up that we've seen in the markets. This is on expectations not only that the Fed is done, but maybe that the Fed's going to be cutting rates next year. Do you buy into this rally, or if the Fed doesn't cut rates, do you think we've gone too far too fast?
It's a great question, Becky. We've been bullish. We were looking for a correction going into the fall of around 10%. We got it. And we've been calling for a year-end rally. Not only that, we're out with our year ahead, and we're calling it the bucking bull for both bonds and stocks. We think bonds go into a bull market next year. And the Fed doesn't necessarily have to cut rates for bonds to be in a bull market. I think the market itself can allow rates to gradually come down. But again, if the Fed does start cutting rates, that definitely would add fuel to the fire for bonds. And as rates have been coming down, equities have been rallying. So we think you can actually hit new record all-time highs next year in the equity market. But it's not going to be a smooth ride the way it has been the last couple of weeks. We think as you go into the month of December, since the markets have had such a big move, we can get a little bit more volatility. But we're still telling clients that, if you're not in the market, to get in the market, because we are looking for new highs next year.
Okay. Would you be selective about where you're putting that? Because if you're looking over the last month, or over this month at least, the NASDAQ is already up 10% just for the month to date, and that's only a couple weeks in. Dow's up 5%. We have seen some rotation, though, where you've seen some of the mid-cap and small-cap stocks that have been doing a little better recently.
Well, I think you can temporarily broaden out your investment. We think the January effect in small caps has already begun. Normally, you get a seasonal rally in small caps in the month of January, but we think you're already in that rally. Another pocket of the market that's very depressed are the banks, particularly the regionals. We think they can bounce, but we only want to rent them. We don't want to own them. We still believe the leadership is in mega cap stocks. When you look at the S&P 500 top 50 stocks relative to the S&P 500, we've had a multi-year breakout, indicating that these stocks will continue to lead. We're also getting a breakout with the Magnificent Seven. So we do think the leadership stays with mega cap and stays with technology.
The crazy story that we've been talking about this morning, Ann, and I don't know how closely you follow OpenAI, Microsoft's investment with this, what this means for other big AI companies at this point that are really making an effort and pushing into it. I mean, this has been a really difficult story to get your arms around, but it's clearly dividing Silicon Valley and raising all kinds of questions. If you're looking at big tech as a place to go, how does that factor into any of these stories, especially when you hear the other stuff that Sam Altman was up to, trying to come up with raising billions of dollars to fund a competitor to NVIDIA with those chips that it makes, too? I mean, this is stuff that really roils a lot of those very big investments in very big tech companies.
Well, Becky, it tells you it's significant, right? You wouldn't be having all of this if there wasn't positioning, because of the potential growth that we're expecting from, artificial intelligence. And really what we think artificial intelligence will bring over time is productivity enhancements. And I'm not even sure we even know how to even factor that in yet. But when I began my career in the 1980s, computers were just entering into the business, and computers themselves added significantly to the productivity model for businesses. So we're looking for artificial intelligence to really be a driving factor for earnings going forward, adding to productivity, taking unit labor costs down. And just having all of this happen, I think, is just another indication of how important this technology will be to our economy, and not only our economy, the world economy.
But how do you play that in the marketplace? I get your point that it's going to be a great efficiency boost across the board to lots of companies. But if you're looking to invest in AI right now, would you do it the way people have done to this point? Is it to buy Microsoft? Is it to buy NVIDIA? Is it to look for other companies out there? Or is it just to buy any of these companies and realize that things will get more efficient with time?
Well, you always want to have a diversified portfolio, and you want to own some of the leaders, which are some of the names that you've owned. One of the ways we specifically have been trying to play this is through semiconductor chips. And obviously, NVIDIA is part of that. In order to actually grow your infrastructure and technology, the one thing you absolutely need is a semiconductor chip. And we're moving to a digital world. And, in your digital world, everything has a chip, from your car to your refrigerator, to your dishwasher, to your washer, your dryer. Everything has chips. So we are staying with the chip theme, but we'd also stay with the leaders that have been leading the market. We don't see them peaking at this point.
The inflationary reads that we got last week were pretty soothing to the markets, to the equity markets at least. You think that we have seen really great numbers and that it's not going to be a concern for the Fed coming back in? This just kind of circles back to what we were talking about at the beginning. If there's one big macro play to make on the markets right now, it's trying to figure out what a soft landing means and what that means for the Fed's perspective. We've seen the dollar come down pretty significantly as traders figure this is the end of rate hikes. What next? If there's additional inflationary numbers that come up, Marianne, is that the biggest thing that would be kind of a fly in the ointment for any of the equities rally here? Because that would mean that the Fed has to stay strong and stay higher for longer?
Well, I think, Becky, the Fed does want to stay higher for longer because they want to ensure that they've battled inflation. But when we look at the inflation gauges like CPI and PPI, we've been saying that they've peaked. In fact, if you just look at headline PPI, that number on a year-to-year basis has already gone negative. We think that CPI has also peaked and come down. And I wouldn't be surprised even if we print a negative number on headline year on year. And then the Fed, if that does happen, is going to have a harder time staying higher for longer. So, right now, it does look like a Goldilocks kind of environment where we can have economic growth, a slowdown in inflation, and have interest rates fall, which would lead to a double bull market in both stocks and bonds.